David here, your Austin real estate expert, and we had a client tell us that they're going to hold off on their search because interest rates are so high. And I wanted to talk about that and how a buyer should be responding when we see interest rates hitting 7% and potentially they could be going higher. Because I think the intuitive thing for most people is to think, I'm going to wait. I'm going to wait till interest rates come back down because the payment's just too high. And there are some buyers where maybe things have become actually unaffordable and they can't qualify. If that's your scenario, that's definitely unfortunate. You could try going to a lower price point and trying to get in something. And after this video, I think you're going to see that that's probably going to be the move. That buying in a high interest rate environment is the best thing you can do, even though it sounds like the opposite advice of what you might think. So it's the contrarian point of view. And let me explain, and I'm going to show you an example here with numbers in a Google Sheet exactly why now is actually a better time to buy than when interest rates drop in the future. So let's dive right in, and I'm going to talk about this example because this isn't a projection, I would say, of what we think is going to happen with interest rates and pricing. It's just a theory of like what could potentially happen. Our stance on pricing in Austin is that it's going to stay relatively stable because what we've had up until this point is a huge imbalance in supply and demand. And so people think that like, oh, well, interest rates are going up, so prices have to go down. No. Because there was such an imbalance. There was so few listings for how many buyers there were that this is just pushing us into equilibrium. We actually wrote a really interesting blog article. We partnered with David Perel. So thank you, David. Shout out to him for helping us with an article about the ugly truth of real estate in Austin. And that is that there's this Newton's law of gravity. People feel like that, oh, the average person needs to be able to buy the average home. But that's not true. That is just an assumption that people are making, and there's no law of gravity that is the case. And it's just unfortunate, but the ugly truth of real estate in Austin is that the average person is no longer going to be able to buy an average size home. Just some estimates, we can play around with them, but one assumption would be that interest rates in December hit 8%. That might be sooner than it happens. We'll see. But the important thing is that right now they're hovering around 7%. We're saying in February, maybe they get up to 9%. And then when do they get back down to reasonable? I don't know what would we consider that, but like historic norms. Now, these people have gotten really used to these 3% interest rates. That's not the historic norm. So we're not expecting it to get back down to that. Let's say it gets back down to like the 5-6% range. To be conservative in our example, I'm going to use 6%, and we're going to first to start talk about that in June of 2024. Our first example, we're going to assume that somebody's going under contract today, October 1st. They're closing in 30 days, which is November 1st. And their interest rate is the prevailing rate of 7%. Now, we've taken into account all the other costs. We're using $1 million purchase price, 20% down, 7% interest we talked about. Taxes in Austin are usually 2.2%, although they vary. They can be as low as 1.7, and they can even be a little bit higher than 2.2. Insurance about $1,500 on a home like this. And the length, so this formula is taking the purchase date, and then when we think rates are going to drop to our historic levels of 6%. And that's 578 days from now. So over that period, this person's going to pay an additional interest of about $12,000. So what I'm saying is if they were to buy today versus waiting to buy the same exact house on June 1st of 2024 and get their 6% rate, they're going to end up spending an extra $12,000 in interest. The cool thing about interest is it's a really simple formula. If it goes up by 1%, you just take the loan amount, in this case, $800,000, 1% is $8,000. So they're spending an extra $8,000 for the year by owning this house for that period. So this period is 578 days, so it's a little bit more than $8,000, comes to $12,668. The cost of a refi on a house like this would probably be about $7,500. So the total cost of owning this home over their alternative is $1,012,000. Oh, no, it's not. I didn't add this. With a quick change in the formula there, now we have an accurate total cost here of $1,020,000. And so this is just to try to compare apples to apples, and you'll see as we go through the other examples. So let's just say we have a buyer that I would say is very prudent and is able to overcome the natural psychology, right? The natural psychology here is like, oh, interest rates are going up, I'm not going to buy. But if you've read any Ray Dalio, he talks about first level versus second or even third level order thinking. So first level thinking or first order thinking is interest rates go up, I'm not going to buy. Second order thinking would say, okay, everybody's thinking that interest rates are going to go up and they're not going to buy. So what's going to happen? That means there's less buyers. That means potentially prices could come down. At least there's more options. So there's more supply. I have more options as a buyer and a potential for lower prices. Now, again, our thesis here is that across the board, pricing in Austin is not going to drop substantially. But that doesn't mean you, as a very prudent and savvy buyer, could not take advantage of the situation here and say, okay, some sellers are going to have to sell and go out and find yourself a really good opportunity. Now, in our scenario, we're just going to keep it conservative and say you get a 5% discount over the pricing today in several months. We got a 5% price reduction. So here we're showing price appreciation as negative 5%. So that gives us a $950,000 price on this $1 million home. Now, everything else adjusts. We're using a 9% interest rate. We're saying rates go up even higher. So you're buying at the peak of interest rates. And this is where people get caught. They're like, I want to buy at the lowest point of interest rates. Yeah, low interest rates are great for your monthly mortgage payment. But for your overall situation, this is an opportunity. And buying at the peak interest rate, as you're going to see, is what you're going to want to do. Taxes, insurance, how many days? So this is obviously less than that one because we're waiting. But the additional interest is significantly higher because this person has a 9% interest rate versus the 7%. Still roughly $7,500 to refi, but their total cost over that period, apples to apples, is significantly less, $33,000 less by just buying in February. Really the thing that I want to compare against, because buying today, I think you're still making a good move, is waiting until June of 2024 when interest rates drop. Because what's going to happen, I don't think this is a surprise to anybody out there, but when interest rates drop, buyers are going to come back into the market. And so then everybody's going to be buying. You're going to be competing with everybody again, and prices are going to go up. So you're doing the same thing that everybody else is doing. I think of this like the stock market. Let me ask you a question. If you have a long time horizon, do you want the stock market to go up or do you want it to go down? Okay. Most people think they want the stock market to go up, but no. If you have a long time horizon, you want the stock market to go down because you're currently buying. This is a couple assumptions, but let's just say you have a 401k, you're buying every month. You want the stock market to go down, so you're buying at lower prices, and then eventually you want it to go back up. And that's kind of what's happening here is you want interest rates to go up so you can buy at a lower price, and then eventually rates will come back down, prices will go back up, buyers will come in, the whole thing happens. So that's what's going on here, very similar to what happens in the stock market. Okay, let's look at scenario 3. This is you wait until June. When everybody comes back in and rates go down, you're able to get a 6% interest rate. Maybe it's even lower, but again, we're just trying to be conservative. And you don't pay anything for additional interest, nothing towards a refi cost, and you buy at $1,020,000 total cost. So your best scenario is the middle one. Let's just throw some different numbers in here. Like, what if you can get negative 10% price appreciation? What if by June it's up 5%? Right? And we can play with some of these numbers and just kind of see what scenario makes sense. No matter what, the best scenario is peak interest rates, assuming you're able to get a discount on price. Right. So that's where having a really strong real estate team behind you to make sure that you're doing that. So what I don't want to happen is buyers to just say, you know what, I'm pausing my search. I'm just going to wait. Okay. The thing to do is say, okay, I'm going to be very intentional, stay in the market, and keep an eye for the right property and the right deal. In times like this, I think the key strategy is, can you acquire really quality assets? Something that you can own, and like the way I'm looking at this is, what's something that I want to own for 10 years? Because some people, this might be your last opportunity to jump in and get something at a discount. Because, I mean, there'll probably be other crises and, who knows? We don't know when those are going to be. But I met somebody at a networking event recently, and he moved here 9 months ago, and he said, man, I moved here at the peak of prices. And I was like, bro, everybody moved here at the peak of prices. So it's no different. Like, you just need to get in when you can get in. There's the saying that the best time to buy real estate was 5 years ago. Second best time is now. Okay, so don't kick yourself. I think that's a thing that many people do. Like, I wish I had bought in 2011. Maybe you weren't even old enough to buy real estate in 2011, right? Okay, maybe it was 2015, whatever. Just don't kick yourself. That's in the past. Control what you can control, which is you can buy now, or at least put the pieces in place to buy when the timing is right. If it's not right now, maybe it's in 3 months, maybe it's in 6 months, but there's definitely a balance here. We talk about not trying to time the market. So you don't want to necessarily try to wait for the perfect moment and try to nail things properly, because if you look at stocks or pricing of anything in general, let's just say here's the chart coming down, boom, bottoms, and then it goes back up. How many people are buying at that very bottom point? Very few, maybe one, maybe a handful. So there's the chance that you're going to be that person and you're going to time it so perfectly is so small. So the goal is not to do that. It's to buy on the way down or on the way back up. So don't try to time this perfectly. Just be in a position working with your real estate team. You reach out to us if you don't have one or you want to talk to us about working with us. Info's below. You can schedule a call with me or Lee directly. We'd love to chat with you and talk about your goals. So set up a strategy here of how you can time this, and don't worry too much about what interest rate you're getting. There's this phrase going around. I'm not sure if I like it or not, but we're going to say it, which is date the rate, marry the home. And so the rate can change. The home, that's what you want to focus on, is acquiring a really quality asset. And now with more supply on the market, there's more options for you to get a really quality home. So little tips I would say when I'm talking to buyers is that house where you would have bought it 6 months ago and it backed up to Westgate Boulevard and it was kind of noisy. You're not buying that home anymore. You're staying away from anything that backs up to a major street or backs up to the train. You're focusing on high quality assets so that when the market rebounds, those are the ones where you're going to get premiums.
The key point is you're not in an efficient market like stock. You're in an inefficient market.
That's a really good point. I actually just read a book. It's by Howard Marks. The most important thing, it's about investing. This hypothesis, if you're not familiar with it, called the efficient market hypothesis, that they say in stocks, all the information's priced in, it's very efficient. In this book, he actually makes the argument that that is not the case, and there's opportunities. That's why some money managers can outperform, is because they can find opportunities of inefficiency.
Right.
So real estate, for sure, does not have an efficient market.
Real estate's the most inefficient market known to man.
The most.
I think so.
Well, it's because you have unique properties.
Correct.
You have unique buyers, unique sell.
Yes.
Everything's unique about every single transaction.
Correct.
And so, yes, it can be inefficient, and there's definitely opportunities.
The other part of it is the delayed timing of the data. Real estate statistics move at glacial speed. Take a look at the most recent market report you got from your realtor or another realtor in the market and see what date they're looking at. This is October. We're reviewing September stats. Most agents at this time are looking at August statistics. So it's a very inefficient market.
If you want a copy of this spreadsheet, go ahead and subscribe to our channel, comment below spreadsheet, and we'll go ahead and get you a copy so you can play around with it yourself. So the bottom line here is don't just wait until things stabilize. Volatility, uncertainty, these are good things if you are a buyer trying to take advantage of getting a good deal and finding the right home. It does take a lot of overcoming your own psychology and focusing on journaling and meditation, some of these things, but you got to really stay focused, work with a team that can help keep you grounded and get to the goal that you're trying to achieve. If you want to talk to us about your goals, please go ahead and in the description, you can schedule a call directly with me or Lee, shoot us an email, find me on Instagram, David Shapiro ATX, whatever it is, and we'll get in touch and set up a time to meet. We'd love to do that. Go ahead and subscribe so you can see future videos from us coming out soon, and we look forward to seeing you on the next video.